Hey investors, welcome back. So I guess I have some explaining to do. My last video uploaded to the channel was back in September of 2021, and honestly, I never intended to take such a long break. A lot has happened over the last 9 months, and I won't bore you with the details, but during that time, my family and I moved to a new house, and I used that as an opportunity to upgrade my YouTube studio. Now, unfortunately, it took me a lot longer to get things set up than I was anticipating, but I really wanted to up my game, and I wanted to provide the best product I could to you, my viewers. Also, with how the stock market has been over the past 6 months, I realized the need to make videos faster so that I could keep you guys informed of the important stock market news as soon as it comes out. Now, a big reason for wanting to focus more on news articles on this channel is because investments can change rapidly, and one stock that is a buy today could be a sell tomorrow if macro conditions change, which is what has happened recently to the stock market. So with that being said, let's jump into the stock market update portion of the video. By now, I am sure it is no surprise to you that inflation is not transitory, like the Fed said, and that the price of everyday items are insane. If you're like myself, someone in the lower middle class who tends to live paycheck to paycheck, this is a very scary time. We all need gas to get to work, and we all need to be able to put food on the table to survive. So with that being said, why is inflation so high? Well, there are a number of reasons, but the one that bears the most responsibility is the insane amount of money our government has spent over the last 2 years. In fact, over the last 2 years, the US spent $13 trillion, and the majority of that money was printed digitally, or in other words, it was printed out of thin air. Now, that $13 trillion can be broken down into the following: $5.2 trillion for direct COVID relief, $4.5 trillion for quantitative easing to pump up the stock market, and $3 trillion for infrastructure. To put that in perspective, we spent less on World War II than we did on COVID relief, spending $4.7 trillion in today's dollars on World War II compared to the $5.2 trillion for COVID relief. And in case you are skeptical about my claims that printing gobs of digital dollars fueled inflation, let's take a look at the chart for M2 money supply. And real quick, before we look at it, we want to focus on this chart because it shows us how much of that digital money made its way into circulation, where it could then be spent. So if we look at the chart for M2 money supply, or dollars in circulation, we can see that there was a huge increase in the amount of money in circulation following the COVID crisis. In fact, the M2 money supply increased by 27% from 2020 to 2021, which is huge. To put that in perspective, that is the biggest jump in dollars in circulation in America's history. It is bigger than the financial crisis of 2008, which was 10%, bigger than World War II at 18%, and even bigger than FDR's response to the Great Depression, which was actually only 10% also. This is crazy levels of spending, and far eclipse all the amount of money we've spent in the past to other crises. So make no mistake, the 2020 COVID stimulus and subsequent spending bills played a direct role in the inflation we are now seeing. So now that we understand what is causing inflation, let's look at how we can stop it. In order to stop inflation, you need to raise interest rates higher than the rate of inflation. If people know they can borrow money at a lower rate than inflation, they will borrow the money to buy things today instead of waiting for them to get more expensive tomorrow, which just makes sense intuitively. However, here's a dilemma. Raising rates to match the rate of inflation would crush our economy, and the effects would be just as bad as not raising rates and letting inflation keep running. And if you don't believe me when I say raising rates would crush our economy, keep in mind that the recent sell-off in the stock market was caused by the Fed raising rates by 1 percentage point. And 1 percentage point is nowhere near high enough to tame inflation. In fact, the latest inflation report has inflation pegged at 8.6%, which is a 40-year high. And to make matters worse, despite falling from 1.2% month over month in March to 0.3% in April, the inflation rate has jumped back up again, with a 1 percentage point hike in May. So inflation is stubbornly high, and while there is a possibility that it comes down on its own, there is also a big risk that it won't. And if left unchecked, inflation could remain stubbornly high or even accelerate from here, which is obviously not what we want to have happen. Plus, it is really scary when the current leaders of our government are using words like hope in regards to the fight against inflation. In fact, hope is the exact word that Janet Yellen, the current White House Treasury Secretary, used when referencing inflation. Quote, "I do expect inflation to remain high, although I very much hope that it will be coming down now." And again, that is a direct quote from Janet Yellen, our current Treasury Secretary. So the bottom line is that inflation is a monster that, if let out of the cage, can act in unpredictable ways and do a lot of harm to the economy. But we do have lessons from the past which can help give us ideas on how to stop the inflation monster today. Back in the 1970s, inflation accelerated, hitting a high of 14.4% in the summer of 1980. And needless to say, this was a moment of crisis. However, a guy by the name of Paul Volcker, who was the head of the Fed at that time, had an idea. His theory was that by raising interest rates rapidly to the point where they were higher than the rate of inflation, you could cut the head off the inflation monster and kill it quickly. And long story short, Volcker's idea ended up working. But just so you know, I've done my research on this. Here is the chart comparing the Fed's interest rate to the rate of inflation back in the 1970s and 1980s. As you can see, inflation did not come down until the Fed raised rates about 2 to 3 percentage points higher than inflation in the early 1980s. So if we know what works when it comes to stopping inflation, why doesn't the Fed simply raise interest rates to 9% and call it a day? Well, the unfortunate side effects of aggressively raising interest rates is that the economy tends to suffer. If we look at this table of historical unemployment rates, we can see that there was a huge spike in unemployment that occurred from 1980 to 1983. In fact, the unemployment rate of 6.3% in January of 1980, before all of this happened, was not equaled until April of 1987, which is 7 years. So make no mistake, there is a steep price to pay in unemployment when interest rates are aggressively raised. And in light of this information, it is not surprising why our elected leaders are hesitant to raise rates. But this is not the only reason our government is hesitant to raise rates. Higher interest rates can negatively impact anyone that holds debt, which includes not only our government, but also a majority of Americans. We have already discussed the insane amount of money our government has borrowed over the last 2 years and how this has fueled inflation. But keep in mind, the Fed funds rate also affects interest rates on things like credit cards, mortgages, and even student loans, which American citizens have record amounts of. In fact, if we look at this chart of total household debt, we can see that household debt is currently around $14 trillion, which is higher than it was in 2008 before the financial crisis. So again, at a time when Americans have more debt than at any other time in our country's history, raising rates would be devastating. Also, not only can Americans not afford to pay higher interest rates on their debt, but our government can't really handle it either. So it is under these circumstances where all we can do is hope, like Janet Yellen says, that inflation comes down without doing what is necessary to actually bring it down. The bottom line is that inflation will most likely rage higher, and with it bring more pain and uncertainty to not only the stock market, but also people's standards of living. But since this is a financial YouTube channel, and I like to always look on the bright side, let's look at what the effects of sustained higher inflation will be on the stock market. Let's take a look at investor psychology as it pertains to this current market. It is my firm belief that we are currently in a feedback loop that will most likely lead to lower lows in the major indexes like the S&P 500 and others. And in order to explain this, I'll show you a good illustration I found that I think sums up things quite nicely. So here it is. The top box says, investors worry about a recession fueled by higher rates. This makes equities trade down. And when equities trade down, investors begin to wonder if the Fed will be more dovish, which simply means less likely to raise rates. This dovish stance encourages investors to be optimistic about the economy and that a soft landing is possible. This in turn makes equities trade up. However, as equities trade up and inflation continues to run hot, the Fed uses this as a sign that the market can handle higher rates. And as interest rates rise, investors again worry about the possibility of a recession and sell their stocks. It's a vicious cycle, but it is exactly what I think is happening right now. And to make matters worse, we have had a Fed that has lowered rates and rescued the market at the drop of a hat for the last 15 years. And I think this mindset has become ingrained in investors' heads and led to a lot of investors being afraid of missing out. Many investors simply assume that at any moment when things get bad enough, the Fed will reverse course and once again flood the market with easy money, like they did in 2020. However, I believe this time is different, and the high inflation rate is what will ultimately prevent the Fed from rescuing the market anytime soon. With that being said, guys, thank you so much for watching, and I'll see you in the next one.